Hello, everybody. Welcome, welcome. Oh, I just had the somewhat terrifying experience of Dell deciding now would be a great time to update my BIOS remotely just before this meeting. So I'm glad that we're all here and we made it. How are you all doing this Friday?
Hey, Daniel, very good. Do you still have your conflict?
What's that?
Do you still have a conflict right now?
Yeah, I'm hosting the I'm hosting the meetings for a venture capital firm that's here in Portland today, and they know that I'm stepping away from it for this hour in order to join this group.
Oh,
So I am actually in a room. It's probably a little echoey at the moment. I don't have my camera with me, but the venture capital conference can wait for this club.
Awesome. Good priority.
Yeah, we feel special, Daniel. Thank you.
No, honestly, it's my commitment to make this happen every Friday. And I see that Karin Hall is in the waiting room trying to join. I've hit join on her. She's our guest speaker today.
Hello.
Hello. Who all's there? Anybody doing anything interesting for Father's Day? Let's just start it off with that. And then we'll get into the meat of our topic here at the Alternative Investing Club.
What's
Nobody?
I'm driving to Vegas.
You're driving to Vegas? What's in Vegas?
The first rule of Vegas is you can't talk about what's in Vegas. So if you
rule.
want to have the conference discussion on the strip, I'm more than happy to send the non-disclosure agreement.
It's what happens in Vegas. That's what.
See, I'm showing my lack of knowledge, Ashish.
I'm celebrating Father's Day by going to the drive-in movie theater with my family. We're going to see The Flash.
Oh, that's fun.
Just hanging out with the family. We'll have dinner there at, kind of a tailgate, even though it's a minivan. And we're just going to have a good evening over at the drive-in movie theater. Welcome, everybody. Is Karin in yet? Karin, are you there? I thought I saw you joining, but I now don't see you. All right, I don't have an email from her. So hopefully she'll be joining. Anybody else doing anything interesting for Father's Day? Congratulations to all you fathers out there.
Yeah, we're going to Sicily, not just for Father's Day, but for a month.
For a month. Do you have family there, or just vacation?
I do not, but apparently that's Portugal and Sicily where everybody's moving. So maybe.
Why are they the place to move?
I mean, Portugal because of taxes. Sicily, I don't know. I think 5,000 years of uninterrupted people living there. It's got to be a lot of culture.
Yeah. My wife visited Sicily in college, and she still talks about it.
Ashish, you're not picking up one of those like coastal Mediterranean villas for $1 that you have to remodel from the ground up and live there for a century or something to avoid the taxes on?
Yeah. Well, if we're all willing to move there, right? I'm in. I'll buy two.
Right.
I was surprised to find out when I lived in Europe for a little while, and I found out that Austria, in order to become a citizen of Austria, you have to have lived there for 4 generations before they'll consider you eligible for citizenship. That just amazed me when I heard that. Right.
Oh, that's commitment.
Karin, are you in the house? I don't have an email from her too. Oh, here it is.
I saw her name on the call and then it disappeared.
Yes. think she's getting hung up on the registration page, apparently. All right.
Ashish, will you be giving
Well, while
a
we're
trip
waiting here-
report when you come back?
I'm
what's
sorry. Say it again, Anita.
Will you be giving us a trip report when you come back?
Oh boy, that's a lot of pressure.
You're just going to enjoy
Maybe.
yourself.
That's amazing.
Oh, all right. While we're waiting here, you know, a little bit of news. The Fed met this week and there was no new rate hike. It was kind of expected. At least a lot of people that were in the industry expected it. I don't know if anybody has any reflections or any thoughts about the recent non-Fed rate hike. I think there may be some more in store for the end of the year, but I'm curious to hear other people's opinions.
Yeah, I think it's interesting how the market's just rocketing upwards. But if you look at, you know, there's restaurants are getting kind of empty. I don't know if you guys noticed the last couple of weeks. Restaurants are much emptier. Stores are much emptier. Like, what is going on?
Mm-hmm.
Okay, yeah, I thought I was going to. We're worried that you're going to surprise other way around.
So, Shashank, you said you were worried about what?
Well, I can say restaurant prices are insane. That's just compared to a few years ago, especially at the lower end, like sandwiches that I used to get for $8 are now $15, and that's just past the threshold where I just don't go.
I think it's interesting, like how, like what the Fed thinks of like inflation. I mean, there are like sectors of the economy that are still hot, like housing, for example. Like that's not coming down. So it's very like interesting. Like, you know, I mean, like they stopped the rate hikes, but I don't think like inflation is coming down.
And interestingly, I don't know if their goal was really to have inflation run in reverse and to actually cause deflation, or just to stop the progression. And I think they've largely been at least partially successful in that. Housing prices are pretty stable right now. In some markets like California, they're going down. On the East Coast, they actually went up, and I think they probably are projected to go up a little bit more with Case-Shiller and some of the other indices tracking them for next year. So I think they've had some partial success, and I think that and fear of crippling the economy stop them.
It's been interesting in the commercial markets too. For commercial real estate, the spreads have been widening. The spreads have been widening, and the buyers, because interest rates have gone up so much, have started reducing their prices, but the sellers have been maintaining their higher price asks, and so you've seen a widening in the bid-ask spread for a lot of commercial properties.
I don't think they're actually stopping the interest rate hikes. I think it's just a pause this month, but I think they're still going to go up.
I think so too. It's a moment to catch your breath.
Yeah, I know. I remember reading the interview with Powell. He said that the interview I read said the implication was because they didn't have sort of perfect elastic response from interest rate to reaction, that they want to give it a little more soak time and see if it takes better.
Okay, our
Hey guys, what's up?
speaker is
Karin's on.
is in the house here. Karin, can you take yourself off mute?
Hey, Daniel, how are you?
Very good. Good to hear from you. And so I think that most of us are here. We're ready to kick it off. So Karin, welcome to the Alternative Investing Club. We started off, of course, as the Intel REI Club and have migrated externally, and we're allowing external participants to be in the group now. But as a club, our goal is to learn from great speakers and to improve our real estate investment skills and skills in other passive investments. So we've recently had oil and gas and some other types of alternative investments here. And we're glad to welcome you as well. Self-directed IRAs are becoming a bigger topic for good and for bad reasons. But welcome here. Are you able to share your screen?
I sure am. Thank you so much, Daniel. I really appreciate it. So let me just do that right now. And so sharing. So there we go. Should I just jump into this?
Yeah. And if people have questions, feel free to put them. Most of you know the drill by now. Feel free to put them in the chat. Karin, I'll judiciously interrupt you, and we'll take questions as you go. I think that's what we decided on the phone, right? We talked about
that. Sounds great. Yeah, whatever you want. You can interrupt me, or we can wait to the end. You know, I think it's most interesting to just get to everybody's questions. So happy to do that.
All right. Welcome to the group.
Thanks so much. So as Daniel said, my name is Karin Hall, and I am the CEO and founder of uDirect IRA Services. I founded the company in 2009 during the recession. And it was really the perfect time because people were having a tough time finding access to capital. You may recall that a lot of banks weren't lending, and that's when I think self-directed IRAs really made a surge in popularity. So what we do at uDirect IRA Services is help you through the self-directed process. What we don't do is give you tax and legal advice, okay? So it's always good as an investor to have a great attorney, have a great CPA in your carousel of advisors. So make sure that you do that. So there's a little disclaimer. And if you just want to silence, if you guys want to turn off your mics, that'd be great. Okay. So we'll move forward. What self-directed IRAs are for is saving for retirement. So when you use a self-directed account to invest, you are investing to save for the future, for your retirement future. So anything you do within a self-directed IRA isn't to put money in your checking account today, and you want to make sure you don't. And we'll get into why that is. But you really do need to save for the future. It's nuts because pretty much just very few people are really truly prepared to retire. There's a huge deficit between what Americans have and what we need to retire. So like, if you were to think about this, if you had $100,000 in retirement, you think, wow, I'm doing great. I've got $100,000. It's a lot of money. But then you realize, wait a second, if you're going to retire at age 59 and a half and live till you're 86 and a half, it's only $400 a month to live on. So I'm really glad that you're tuned into a program like this, a podcast like this, so you can learn so much more about how to save for your retirement, because you're definitely going to need to do that. And when you're using a self-directed IRA, the funds that you earn, the proceeds from your investments, are tax-free in a Roth or tax-deferred. So that really helps you build your retirement. So right now, today, there's around $40 trillion in American retirement savings. It's a very big number. And the reason I'm telling you about this is because if you happen to be not just investing for your own future, but actually raising capital for your deals, self-directed IRAs are a great pool to pull from for your deal. So you can talk to investors and say, hey, this is my investment, this is what I'm doing. Do you have money in an IRA or maybe a 401k with a previous company? Because if you do, you can take that money and do a transfer or a rollover into a self-directed account. And then you can use that money to invest and build for the future. Okay. So if you haven't heard about a self-directed account, I mean, a lot of people haven't. In fact, there are plenty of attorneys and CPAs who actually still haven't heard about this, even though self-directed IRA accounts have been around since 1975. Seriously. That's when Gerald Ford signed the ERISA laws into effect. So this is nothing new. Self-directed IRAs have been around for a very long time. So what's the difference? What makes an IRA self-directed and what makes it just a plain IRA, right? Well, the typical IRA, that's going to invest in what's called market correlated assets. So assets like, stocks, bonds, and mutual funds, anything tied to the stock market. A self-directed IRA is going to invest in the alternative asset world, like private equity, rental property, tax liens, precious metals, notes, buying performing and non-performing debt. I mean, so many different things. So a self-directed IRA and a typical IRA, their IRAs, they have all the same rules. The only difference really between the two is a sort of asset that can go into the account, right? So the only difference is the sort of asset that account will hold. The rules for how the money goes in, the rules for how the money comes out, they're the same, no matter what kind of IRA you're in, okay? And this, which is to say, self-directed or typical, okay? Now, I think it's important before we get talking about self-directed IRAs and how to invest that you kind of begin with the end in mind, Stephen Covey, right? So what if your IRA invests and you lose money? Well, you don't get to write it off. And so given that, you want to make sure before you invest that you do your due diligence. Check out the people you're investing. Who are they? Google them. Talk to people who've invested with them. Do your homework before you pull the trigger. Fully read the agreement, the contract, so that you're completely aware of the terms and understand this is a self-directed account. And what that means is that you're responsible to go into your account, look and see, hey, did the proceeds for my investment come back? You need to check your account monthly and just, babysit it and see what's going on. It is self-directed, so you need to police your account. Okay. So when it comes to self-directing, and when the IRS created these accounts, they created limits, and they said that really that the IRA can do anything except invest in life insurance contracts and collectibles, okay? That's a pretty broad spectrum of assets. We'll get to this in a while and kind of sort this out, but that means your IRA isn't going to invest in life insurance, but it's also not going to invest in like collectible metals or cars or like diamonds are collectibles, no artwork or anything like that. So your IRA can invest in anything except life insurance contracts and collectibles. Now, if you're thinking this sounds pretty great, wow, I'd really like to self-direct. There are some assets I would like to, invest in using my retirement. And I have this account where I currently work. Understand there's a catch here, because if your money is with your current employer, you're probably not going to be able to move those funds into a self-directed account. Now, if you have a 401k, you can go to your plan administrator at work and say, hey, does the plan offer what's called an in-service transfer? So you're in service, working there. Are you allowed to transfer the money over? And so the plan administrator will tell you if there is a clause to allow that within your account. Otherwise, if it's a current employer, you have to wait until you leave the service of the employer if you can't get that in-service transfer. Good to know. So I think that there's no good conversation about self-directed accounts without understanding the rules. Rules are incredibly important when it comes to self-directed IRAs, because this is a game of keep away from prohibited transactions. So if you're a rule book person, you want to know what are prohibited transactions, you can look it up in the Internal Revenue Code. IRC, Internal Revenue Code 4975, will go through all the prohibited transactions, right? And so let's cover them a little bit here. You can also understand prohibited transactions by reading IRS publication 590, which is now broken down to A and B. So publication 590B talks about prohibited transactions, but basically you're not going to borrow money from your IRA for any purpose. It's not to borrow from. You don't sell any property or non-cash, you don't sell anything to your IRA that you personally own. Your IRA is not security for you to go get a personal loan. And when you use your IRA, it's not for personal use. You're not going to buy any asset that you'll have the personal use of, okay? Now, going forward here, I think it's important to know that some people are qualified and some people are disqualified to the IRA. Because again, if we're going to play a game of keep away, we need to know the rules, right? So what are the rules of the game? One is keep away from disqualified people. They're your lineal ascendants and descendants. So it's your parents and grandparents. You and your spouse are both disqualified. Your children and your grandchildren are also disqualified. All right, so just kind of put that in your head, and then we're going to go on. The qualified people are out to the sides on the family tree, like your aunts and uncles, your brothers and sisters, nieces and nephews, your neighbors, you know, that kind of thing. They're qualified. Your IRA can invest in an asset that benefits these people. So when it comes to prohibited transactions, I'll kind of give you a, you know, like a high level view, and I'd be happy to take any questions that you have about these. But again, you want to avoid prohibited transactions at all costs, because if your IRA does commit a prohibited transaction, it's game over, right? Game over for the IRA. The IRA ceases to have its like little tax protected bubble, and that money can become taxable to you. So neither you nor any other disqualified person can benefit today from the IRA. So your IRA does not, for example, lend money to your child to go to college. That's a disqualified person having present benefit from your IRA account, right? Your IRA does not invest in a property like a house and then have your dad move in, because your dad is a disqualified person to you, and he cannot have personal benefit or personal use of an asset that belongs to the IRA. Super important that you understand this. Now, also, you're not going to buy, sell, or exchange any assets between the plan, the IRA, and any of those disqualified people. So your IRA doesn't buy, you know, say like buy a house from your mom that your mom personally owns. Your IRA doesn't acquire any houses or any assets you personally own, okay? Now, a third rule here is that the IRA does not allow any disqualified person to provide goods or services to the plan. So what's that, right? Well, sometimes we call this an over-contribution of sweat equity. You're not allowed to go in there, say it's a house, to swing the hammers and pound the nails and all that. You're not allowed to do that. So hopefully we can mute Dennis right here. And so, so you're not allowed to do any of those things. These are prohibited transactions. Now, it can get a little in the weeds sometimes. So that's why at uDirect IRA Services, we offer you a free consultation. So what you can do is, you know, go to our website, uDirectIRA.com, click on the button, request a free consultation. We'll discuss your investment to see if it sounds like there's a prohibited transaction. Okay, so if we're playing a game of you know, a self-directed IRA game, we want to know who are the players. So the player first is you, and then the tool in your tool belt is the IRA. The self-directed IRA could be a self-directed 401k, but the self-directed IRA account is a tool that you use. Then there's uDirect IRA Services. And when I formed the company, again, back in 2009, I enlisted the services of a trust company custodian to do the cash management. Okay, so these are the players in the self-directed IRA game. Since a lot of people are real estate investors, and since just a great amount of alternative assets ultimately are involved with real estate in some way or another, we'll talk about buying real estate with your IRA. Now, there are definitely pros and cons. So just to be fair, let's talk about both, right? So the upside of having your IRA invest in real estate, just brick and mortar, you can touch it, real estate, you know, people can live there, is that any gain, any positive cash flow comes back into the retirement account, the self-directed retirement account, either tax-free in a Roth or tax-deferred in a different kind of account. So you're not going to get hit with a tax burden when your retirement account makes a profit. Okay, no time limit for holding property, like there could be, for example, in a 1031 exchange. So there's no time limit, no clock ticking with this. Your IRA can borrow money, and I'll discuss that further in just a minute. But the greatest thing, I think, about a self-directed IRA is this potential to earn a higher rate of return because you're compounding faster. And how is that true? That's true because you invest, and then you've got some sort of liquidity event, or you get proceeds. Those proceeds come back into the IRA, not diminished by tax. And now that money that your IRA has earned can go back out into your next deal. And you keep churning and churning and churning, tax-free, tax-deferred until you retire. That way you can keep using that money that's not diminished by tax. Super cool. Now, a lot of people will say, don't invest in real estate with your IRA. And so here, let's talk about that. So there's one question that is are you going to buy this property with your retirement account or personal? Like if you've got a choice, maybe investing in this property or real estate makes more sense to do it personally. You want to talk to your tax advisor, hey, which makes more sense for me? But say, for example, you don't have the money personally to purchase that particular asset, but you do have the money in a retirement account, and you can acquire that property using a retirement account. All right. So the downside of using a retirement account is you don't get the exact same tax benefits that you do when you invest personally. Like you're not going to write it off on your 1040. You're not going to take depreciation or anything like that from your personal taxes. There's no deduction for capital losses. And of course, with any self-directed IRA investment, you, the account holder, are solely responsible for any kind of gains or losses because it's self-directed. You are choosing the asset. We're not choosing it for you. We do not recommend any investments to you. It's entirely self-directed. And of course, as I was explaining at the beginning, losses are difficult to replace, okay? All right, so let's go on. I did mention that an IRA can take a loan, and part of my background in my career was I was in mortgage loan servicing a very long time ago, and also in loan origination. Okay, so I was really surprised at the time when I learned that an IRA can actually borrow money. I know that there are a lot of banks that will lend money to a person, but actually to a retirement account, yeah, guess what? It's called a non-recourse loan. So the IRA can borrow money using a non-recourse loan. Now, there are not a lot of non-recourse lenders to choose from. So if you like a list, I'd be happy to send that to you. My staff will be happy to send it to you. Just send us an email, info@udirectira.com. Ask for the list of non-recourse lenders. We'd be happy to send it to you. So here's what happens. Your IRA is not a down payment on a loan for a property like it would be if you were buying the house to live in. A non-recourse loan is a commercial loan, and when you buy a house, you're going to pretty much put 5% down and borrow 95%. Well, when your IRA is investing in a property, it's a different game. Your IRA is coming in with more cash into the deal and taking a smaller loan typically, okay? Now, one of the things you need to know that if your IRA does borrow money, it can lead to a tax. I did mention not a lot of lenders to choose from. And of course, you're not going to personally guarantee any loan to the retirement account because, of course, you're disqualified. And that would be a disqualified person providing services to the plan. So you're not going to do that. Now, again, when your IRA does invest and your IRA earns proceeds due to leverage, there is a tax called UDFI, unrelated debt financed income tax. So what it is say, for example, you're 30% leveraged and here comes a rent check. Well, 30%, that 30% of the rent was earned because of leverage, not because of savings. And so it's just that 30% that's subject to this tax or whatever your pro rata, deal is there with the lending. Now there's kind of a twin tax here called UBIT, unrelated business income tax. An IRA can be taxed with UBIT, not income tax, but unrelated business income tax when the IRA invests in an active business, like if your IRA were to invest in a franchise, or if you did a lot of flips in your in your IRA in a year, it would be considered active income and lead to UBIT tax. So I recommend that you discuss this with your tax advisor before you go forward. Discuss it with us. We'll chat with you about it. Read about it. You can read about these twin taxes on the IRS's website, irs.gov, publication 598. And just go in, forearmed, forewarned, and be ready and know ahead of time if you're going to have to pay these taxes. One time that people can kind of get caught up, this tax, not realize they got into that, is when investors use their retirement account to invest in private equity, like a syndication, also called like a Reg A, Reg B, C, D offering. If that asset sponsor who is offering you the private equity investment is also taking on leverage in that deal, that because there's leverage in the deal, it can pass through this tax to your IRA. So again, I'll be happy to go deep on that if you want to in the Q&A, or what you can do is call us and we'll chat with you about it, personally. Okay, so when it comes to buying real estate or really any other asset, there's a process, and it's open, fund, invest. So when you buy real estate in particular, first you want to open the account so that You've got it open and funded so that you're ready to have us disperse money for an earnest money deposit when you're ready. But the IRA is the buyer. So you give us the documentation, we review it, fund it, it records, and then all rent payments, all proceeds are paid to the IRA, never to you personally. All proceeds are paid to the IRA, okay? Now, here's an example. This is really an exception to the rule. This is important to know. So it is true that a father and a son could buy a property together using their retirement accounts, right? Even though they're disallowed. So let's talk about it. In this case, we've got a father and a son. They want to buy a house together, and dad's going to come in with 50% cash. The son is going to come into the deal with 50% cash. So the title will read, the custodian for the benefit of the son's IRA, 50% owner, dad, 50% owner, tenants in common. So that kind of answers that question. But wait a minute, aren't they disqualified? Yeah, they are, but this is a loophole, which is really convenient to know. And the disqualified people can invest together as long as they do so concurrently. They record at the same time, all right? So as long as neither one of them had any ownership in the deal ahead of time, and because it's a new deal, that's why they could invest concurrently, all right? Now, if they do that after the deal, they could never buy each other out. They will receive their pro rata share of any proceeds and pay their pro rata share of the bills, because when an IRA owns an asset, the IRA has to pay its share of the expenses from the IRA account, not person. Okay. Okay. So after the deal, they never can buy each other out. And as I did mention, for expenses and proceeds are split. So I did mention that all expenses are paid for by the IRA. Okay, so given that, what happens if your IRA depletes its reserves? What if your IRA were to buy something like a house or invest in private equity and there's a capital call, or something happened where your IRA needed to pay some kind of expense of the IRA asset and you don't have the money in the account? First off, you want to leave a pad. That's really important. Leave idle cash in the account so you're prepared for this sort of thing. But if you're not, you could make an annual contribution. Contributions vary. I mean, every kind of retirement account has its own rules, like a traditional Roth, SEP, simple, inherited IRA, 401k, all of them have different contribution rules. So, but you could discuss it with your tax advisor. Hey, how much can I contribute, and make that contribution? Your IRA could bring money in from another retirement account, do a transfer or a rollover to add money to the self-directed IRA account, so you've got the money to pay for that expense. You could also take a loan. Your IRA could borrow money as long as it was not from a disqualified person. But if your IRA just can't pay the expenses of the asset, then you'll need to sell that asset and the proceeds will go back into the self-directed account. All right, so this is a good cautionary tale here to say, leave enough idle cash in your account to cover expenses of the IRA assets. Okay, now changing gears a little bit here, there is another way to go about this, and that is with what's commonly called a checkbook IRA. What it really is an IRA-owned LLC. It's a special purpose LLC that the IRA were to, purchase it. So a third party creates it. The IRA buys 100% of the initial units of that LLC. Your IRA will fund the checking account of that LLC, and now you've got check writing control. All right, well that sounds good, and it can be. I definitely only use this if you need it. I think it's low-hanging fruit for any IRS auditor, because a lot of prohibited transactions happen in this. And the reason that happens is because there's no second set of eyes looking at your deals, scanning for prohibited transactions. But anyway, checkbook IRA is a tool you can use. So basically, what you want to do is just understand that with the checkbook IRA is that you have to follow all the rules, all the IRS rules, and make sure that you do not commit a prohibited transaction in that LLC. All right. So when it comes to self-directed, we call them self-directed IRAs, kind of like an umbrella term, right? But there really are different kinds of plans that can be self-directed. So there's the IRA family, the traditional Roth, SEP, simple, spousal, inherited IRAs. IRA is an individual retirement arrangement. Also, a solo 401k can be self-directed. These other qualified plans are ERISA plans for companies with employees and typically are not self-directed. But you can also self-direct a Coverdell, which is also called an ESA or education savings account for kids, or a HSA, a health savings account. So we talked about self-directed accounts. It includes pretty much all these, except for the ERISA. So how do you do this? How do your investors self-direct their retirement so that they can invest in alternative assets and build, the retirement nest egg? It's 3 steps. Open an account, basically fill out a form, give us some, documentation like your driver's license for the Patriot Act, that sort of thing. Fund your account either by contribution, either by an IRA to IRA transfer, or a rollover of a previous employer plan. So those are 3 ways to fund the account. So you've got it open and funded, and then you give us the documentation for the asset, like the contract. We review it, and assuming there are no major red flags, we fund that deal. Now your IRA has invested, you have self-directed, and 100% of the proceeds due to the IRA or the retirement account for that asset must go into the retirement account that owns the asset. Super simple. Money has to go back, not to you personally, ever, 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 but it has to go back in the retirement account that owns the asset. Super important. Okay. So I'll be happy to take some questions. I see we have a great number of them, but I'm going to go ahead and leave the screen up so that you can have my contact information. I'd be extremely happy to address any questions that you have. So I'm going to start up here from the top, and let's see. So I put the URL for the company, uDirect IRA Services. It's right there, so we have a lot of information online. You can find that. So,
hey, Karin, I've been following the dialogue here and marked a couple of good questions. If you want me just to read them out to you.
Oh, that would be wonderful. Yes, please.
All right. So first of all, starting with Anita, what are some good things to look for when vetting an SDI provider?
Wow, for a provider. Okay, that's great. So if you're vetting a self-directed IRA provider, Anita, it's a great question, because what you want to do is, are you getting your money's worth? Are you getting a good deal for what you're spending on fees? And are you receiving the kind of service that you need? Is the self-directed IRA company going to be responsive? uDirect gets high marks on both of these. So our annual fee is $275 a year, a flat fee, regardless of the number of assets and regardless of their value. So what you want to do is look at the fee schedules and compare the fee schedules to see what you're actually going to pay for the service. In other words, this fee is going to eat a little bit into your ROI. So you want to make sure you're getting the best deal. And then, talk to people who's getting the best service, and you can look at our reviews and so forth and make your decision based on service and fees, I would say.
All right. Henry is asking a similar question. He wanted to know about the cost structures as well, but he's also adding the element to it that he's interested in the self-directed IRA insurance. Is that to protect investments like FDIC?
There is no self-directed IRA insurance that I'm aware of. There is FDIC insurance, which insures retirement accounts up to $250,000. So that's FDIC insurance, which is, federal deposits, there you go, the federal depository. But there's not self-directed IRA insurance per se.
Hey,
if
Henry,
IRA,
if you're on the line, I want to make sure I got that question correct.
Yeah.
Is that what you intended me to ask? Okay.
Okay. What was the other part of the question? I'm sorry.
Oh, the other part of the question was, no, that was the end of the question.
Okay.
Let's see.
I mean, what
next.
you want to do is, when your IRA is when you've got a self-directed IRA, you put the money in the account, but then what you're going to do is you're going to go put that money at risk in the market. So once your money leaves the self-directed IRA account, it's now at risk in that asset. And say, for example, you invested in, I don't know, a private equity, and for some reason that deal didn't go through and you lost money, there's no insurance for that. You're investing and there's risk. So when you take the money out of the account and invest it, like any investment, there's risk. And so you want to carefully assess that ahead of time.
Then the information has to somehow propagate back to the this.
Hello?
Hi.
I think you put yourself on mute, or I did, one or the other. I think he was
well,
asking about how the information gets propagated back to the investor. I assume the leverage ratio is what he's referring
which
to.
information?
You can unmute yourself again if you want to ask the question.
And if you'd like to ask it personally, go ahead and email me here, khall@udirectira.com. But I'd be happy to answer any other questions.
You know, Glenn is actually, his question, which I'll ask not in the next one, but after that, is going to deal with how do you know how much leverage is on a deal and how does that affect your UBIT? But Don is asking the question, can you build a property on top of land that you own in your own name with IRA funds?
Okay, two totally different questions. But before you invest in private equity, like a Reg D offering, you want to ask the asset sponsor if they're taking on leverage. And if the answer is yes, then you need to understand and discuss it with your tax person how that might affect you. Because when there is leverage in a deal and when UDFI tax may be due, your tax person will file what's called a 990T. So when you and I do our income taxes, we file a 1040. When an IRA owes UDFI tax, it files a 990T, and your tax person can take deductions. So you may end up needing to file a 990T, but you may not actually owe any tax. So this is a tax question to discuss with your tax person. And the second question was what now?
You know, I was just going to add something to that. As a person who owns a company that does a lot of Reg D 506 Cs and Bs, we almost always disclose that number in the investor presentation, and it's usually within legal documents as well. And I follow a lot of other companies that do this as well, and it's almost universally in the investor presentation.
Excellent. Yeah, and that's just responsible for the asset sponsor.
Yeah. So the question here was, can you build property that you own in your own name with IRA funds? So can you build a structure on top of land that you own in your own name?
That's a great question. And the answer is no. And I want you to understand why. It's because doing so would be a prohibited transaction. Why is that? Because if you own the land and your IRA builds a property on top of it, you are receiving personal benefit from your IRA. So in other words, the personal benefit you receive is that the value of the land you personally own goes up when there's a house on it. It just increases the value. So you see what I'm saying? So your IRA would not build a property on land that you personally own. That would be a conflict, and that would be a prohibited transaction. So you're not going to do that.
Okay, Glenn was asking a little bit about investing in syndication deals, and we touched on that a little bit, but maybe you could talk about a little more about what uBIT is and how that comes into play if you're in somebody's private equity deal.
Okay, if you're in someone's private equity deal, you're probably not going to pay UBIT. It may be UDFI, unrelated debt financed income tax. So every year, the asset sponsor will send a K1 to you and will indicate, the leverage or what UDFI tax you may owe. The UDFI tax rate is pretty high, but the tax is not going to be on the entire investment. That's good news. It's only going to be on the fractional portion of the asset that has leverage. So what is the percentage of leverage in that deal? And that'll be the percentage of proceeds that you'll pay UDFI tax on. So again, this is why it's super great to have a good tax person. And we use Keystone CPA, just to throw one out there for you, who understands real estate investing, who understands self-directed IRAs, and who understands how to do a 990T and what UBIT and UDFI are, so that they can correctly complete those forms for you. But again, when your tax person is filing a 990T, they're going to look for expenses that they can use to offset any tax that is owed. So it's a conversation to have upfront with your tax provider.
Okay, I was just noticing that we have a ton of questions that have just come in, and it's easily going to take us all the way to the end of the meeting. So
great. Well,
I'm just going to start asking here. Ashish is asking, is there any chance of getting a self-directed 529 plan?
Wow, no. And here's why. You can do a self-directed ESA, or also called a Coverdell, but the 529 is a state plan. So it's not a federal plan. All these other accounts are on the federal level, governed by the Department of Treasury, which basically entirely is in charge of the IRS. So 529s are state-based, but the Coverdell and all the other self-directed accounts are federal, and that is the reason.
I know that Glenn and Ashish have asked quite a few questions here, so you'll forgive me even though yours are next. I'm going to jump to some other people's questions first. Don is asking, if you buy a rental property with your IRA, how is rental income classed? Does it go back to the IRA? If it's distributed, is it taxed as capital gains or income?
Well, once the rental income is not taxed. The rental income goes back into the IRA that owns the property, and then whenever the time comes that you pull the money out of the retirement account, then it's taxed like regular income tax at your regular tax rate. But again, I don't give tax advice, but I think that's pretty straightforward about the proceeds from self-directed plans. They go back into your retirement account, tax-free or tax-deferred, which is one of the great things about self-directed investing.
Jane is asking, can you mix property investment dollars between your own and your IRA in a single property?
Don't do that, no, because again, what you want to avoid is a prohibited transaction, right? If you commit a prohibited transaction, your IRA ceases to be an IRA, ceases to have its tax protection. If it is a prohibited transaction, I mean, this is worst case scenario. I've rarely seen this happen. It's just remotely possible. Okay, I've been doing this 17 years. I've only seen it a few times. But that bubble bursts and you have to pay excise taxes and penalties and all that if it should happen. So don't mix your personal money with your IRA money on a deal. How do you say you didn't receive personal benefit from an investment you did with your IRA? If there are proceeds, you'd absolutely receive personal benefit, and that is a prohibited transaction. So I would never personally mix my own personal money with IRA money, because I would run the risk of having my IRA disallowed, and and I'd face penalties. So I would have definitely avoid that.
Ramesh, I like your question here. He's asking, if I open an SDIRA account with uDirect,
Yes.
what happens while I'm waiting for the deal to invest in? Do I keep the amount in liquid cash? Do I invest in something else like a bond or a CD? How do you have money markets available? How do you keep your liquid assets?
Right. Well, your money sits in the self-directed IRA account. It only earns a fraction of a % of interest, but it's also not subject to any market volatility. So it's you're also not losing money. That's what I'm saying. So the money sits in the account as idle cash until you invest, and that's how that works.
Is it possible to have a strategy where you might want to invest for a short period of time in something else like a money market account or a bond or a CD, something that's liquid but maybe gives a higher interest rate?
We don't sell any assets at all, and so we're not broker dealers, and so we're not selling any assets. So the money is going to sit in the account as idle cash. Now, if you have it already in an IRA with someone, like it's in a money market, leave it there until you want to move it over to invest. But while it's sitting in the account, it just earns like 0.1% of interest, and again, is not subject to market volatility.
Okay, and I understand that you don't sell these, but could somebody who has an SDIRA account, be 3 months in a bond and then move it over to?
Well, where are they going to buy the bond from? You see what I'm saying? We're not going to sell it to them. So they could leave it in another IRA, but no, it's not going to be in a bond. It's going to sit there, and as I've explained.
Okay.
Yeah.
Here's a question. Does that mean, okay, so this is referring back to the FDIC conversation. Does this mean that we should max out our SDIRA accounts at $250K?
I think what you should do, what is the right thing for you. It is self-directed, but at the same time, if you want to buy a property that's $500,000, you can put $500,000 into a self-directed IRA and invest, and then if some and then the money is out there in the investment and you're risking that. So when you're doing this, any kind of investment involves some risk, right? So there is some FDIC insurance, but at the same time, you're not opening a self-directed IRA for the purposes of just holding that, holding $250,000 there. You probably want to invest that $250,000, and when you do, there's no insurance. It's completely at risk in the market. So I wouldn't worry too much about FDIC insurance. We've never had an issue.
All right. There's a couple of good questions here. They're going to have kind of an open-ended response. We've got, let me start with Brooke's question. Earlier, you said that your funds are with your current employer. If your funds are with your current employer, you must wait until you leave or ask for an in-service transfer. Later in your deck, you showed how to self-direct and mentioned annual contributions. Is it possible to open a new account and fund it while current funds are with an employer? And I might add on to that, is it possible to have your own, side business and fund it through that while you're with your current employer?
You can. Yes, you can. Say, for example, you've got your employer has a 401k and you want to contribute, say, to a traditional or Roth IRA, you can absolutely do that. You've got contribution limits, there are caps, and it's $6,500 if you're 50 or under 50, and $7,500 if you're 50 plus. So there's a catch-up contribution there. So yes, you can absolutely contribute to a retirement plan, an individual retirement plan, while you're also contributing to a 401k at work. You can do that.
All right. And then Ashish is asking, some of the larger IRA companies limit the number of types of investments that you can invest in. Do you have any, I guess, just responses or thoughts about why they would do that?
Right. Well, I mean, all self-directed IRA companies do that. It doesn't have anything to do with the size. But yes, so the IRS says you can invest in life insurance and collectibles, but a self-directed IRA company will also say, hey, there are some assets that are not administratively feasible for us. In other words, as a self-directed IRA company, we decide that these are asset classes for business reasons we do not wish to custody. For example, one asset we don't custody is racehorses. There are self-directed IRA companies that let you invest in a racehorse using your retirement account, but that's an asset class we choose not to custody. So I hope that answers the question.
What are some of the other assets you can't invest in? Can you invest in crypto or other things that are not life insurance or collectibles?
Yes, and yes, with us, I mean, when you're talking about uDirect, yes, you can invest in cryptocurrency if you wish. You can invest in, precious metals. You can invest in, all alternative assets, pretty much. I mean, there are a few exceptions, rare exceptions, but yes, cryptocurrency is allowed.
Okay. Let's see here. Ramesh is asking, are there any differences between an SDIRA and an SD401k?
Oh yeah, that's a great question. So an IRA and a 401k are very different things. An IRA is an individual retirement arrangement. A 401k is, whenever you see the numbers, it refers to the tax code. So a 401k is typically an employer plan. So to have a 401k, that means that you're self-employed, like an individual, like a solo K. You're self-employed, you have no full-time employees in any of the companies that you own. And you're using this solo 401k as your employer plan. So it's a different animal, has different rules, different contribution limits. And the solo 401k has a lot of bells and whistles that an IRA doesn't have, like actually being able to borrow money. You can borrow money from a solo 401k for personal use. You have to pay it back, but you can't do that with an IRA. So that there are different rules for each account type, but there's a big difference between the 401k and the IRA.
Here's a couple of quick questions. First of all, Kolar is asking, can an existing rental property be transferred to a SDIRA?
It can't, and that's because first off, if it's existing, you already own it, and the IRA cannot purchase an asset that you already own because you are disallowed to the IRA, okay? And also you can't contribute an asset because the IRS only allows contributions to be made in cash. So you can't contribute an asset to your plan. So the answer is, yeah, you can't do that.
I suppose the IRS would hunt you down if you sold it to your nephew and then he sold it back to your IRA.
Yeah, well, there's a rule for that. It's called the indirect rule. If you can't do it directly, you don't do it indirectly. That would be a prohibited transaction.
Right. All right. Can you do a 1031 inside your SDIRA?
I mean, you don't need to, do you? Because the money that goes into a self-directed IRA is already tax deferred. And you're not going to pay income tax on that money until you take the money out. So, and typically, and like 99.9% of the time, the 1031 is for your personal dollars, not your retirement, not your qualified retirement dollars. So the 1031 exchange and the IRA live in different universes. The 1031 exchange is for your personal dollars.
Joe has got a great question here. He's asking, can you invest in traditional stocks as well as other properties in your SDIRA?
You can, but I mean, the self-directed IRA account that we offer is just for alternative assets. So you can have one IRA, in a Fidelity or TD or Northwestern Mutual or some sort of, account like a stock trading account over here, and have your market correlated assets in one account over here, and have your alternative assets in a self-directed account. You can do that.
All right. Can you use your SDIRA to invest in a brick and mortar business, such as a restaurant, that the IRA owner plans to manage and direct and operate?
Oh, well, I mean, yes and no. You can do it. Your IRA can buy a business, but then you would owe the UBIT tax, unrelated business income tax. And you could never have you can offer services to the plan. So you would not work in the store. You would not offer your sweat equity into that asset. So I would not personally buy like a franchise or a store with my retirement account, because I would run into too many prohibited transactions and high, UBIT tax.
All right, Ashish is asking the advanced investor question here. Does uDirect have partners that offer enhanced IRA to Roth conversions, where the IRA's future market value is discounted to reduce the increase to the AGI and therefore lowers taxes?
Yeah, I'd be careful playing fast and loose with that. What are you talking about? There's a lot. One of the things the IRS is really concerned about is Roth fraud. That just smells, whatever you're talking about. I've literally never heard of that. We offer a Roth conversion. If you wish to convert from pre-tax to Roth, you can do that, and we certainly offer that. But getting some sort of tax, super benefit, I'd be very leery of that.
All right, boy, we have more questions than I can possibly get to here. Thank you, everybody, for so many good questions.
Yeah, I'd love to, answer them offline. So, if you want to send me your question at khall@udirectira.com, I'd be happy to answer each and every one of them.
Tatiana is asking, and we just have 2 minutes left. Tatiana is asking, Karin, could you possibly issue a CPE certificate for attending this learning session? Can I provide that format? What is a CPE certificate? I'm actually not familiar with this.
Well, like continuing education, I think is what you're talking about. So,
yes, for CPAs.
Mm-hmm. Right. So no, I don't think Daniel has set this up to receive continuing education credit, not for this class today, no.
Okay, all right, thanks.
You always want to spend your time wisely, and getting CPE is great, but this class does not qualify.
Okay, yeah. Thank you.
Sure.
And then last question here, if somebody is a real estate professional managing properties, can they charge typical fees to manage properties held by the SDI?
All right, you would, there's actually a court case about this. You would never be paid to manage your self-directed IRA owned property yourself. What you could do is you can do some things that are okay. They're not disallowed. Like you can screen the tenants. You can pick up and collect the rent checks. You can hire third-party vendors to do the work. And you can hire a third-party property management company, but you're not going to do the property management yourself, where it comes to, again, offering services to the plan, like walking in and changing out the sweat equity stuff, like the maybe change a water heater, change a garbage disposal. You would not do that. You would hire a third party, keep it arm's length with a self-directed account.
All right, there are a lot of people with a lot of questions, so yeah. I would encourage you to contact our guest speaker here. And I noticed that I pronounced your name wrongly at the very beginning. Could you pronounce it all for us, just so that we have it in our heads?
Yeah, I know it's this is my life. Karin is my name. Karin, not Karen. It's Karin. It's Norwegian. It's not like an affectation. It's a Norwegian name. So there you go.
Well, Karin, thank you for coming in. Could everybody take themselves off mute and thank Karin for coming in and speaking to us today?
I really appreciate it.
Thank you.
Thanks, Karin.
Yes.
Thank you.
Thank you.
Daniel, can I ask you a question to you, Daniel?
That's awesome.
That sounds
Thank you.
good. I heard whoever that was that has a question for me. I'll stay on the line.
Okay.
Yeah.
But
Thank
thank you
you,
for
Ken.
coming in, Karin.
Oh, it's just a joy.
Thank you.
Thank you for having me. Really
Yep.
appreciate it.
Next week, we have a speaker coming in, and he's going to give us an update on the real estate market within Minnesota and the Dakotas. So an interesting area we have not talked about yet.
Daniel, my question.
Whoever's there, you know what? Do you want to do the question here with people on the line, or do you want me to call you separately?
Oh, I guess we could do separately. How would that work though? I don't,
Hey Daniel, can I ask a quick question that's not, can we take all the questions that were in the chat and do like one email to Karin and then have it replied to the group? So we can all see the answers?
Yeah.
Instead of individually going back and forth?
Yeah, I could do that. You can send it out. Sure.
and
All right.
yeah. Yes.
All right. Nadosium, is it
yeah.
you speaking?
Yeah, that
Go
is
ahead and
me,
just
yeah.
ask right here.
Okay, yeah, the question was, so going to the alternate investing club, I noticed that there is the Speaker Hall of Fame, but I only see 7 people there, so I
The
don't know
last
if
7. Yeah. So I've got an intern, or hoping to interview an intern very soon to finish off the work that's needed here. It's a lot of work going back and tagging and getting the descriptions and editing the videos for Intel related things that shouldn't be public, like names. So I'm in the process of doing that. I'm posting everything that we're currently creating going forward and working hard to get the previous stuff in. When the previous stuff is there, it'll all be in the Speakers Hall of Fame. For some of it, you may need to create an account on alternativeinvestingclub.com. Because you'll have things like the speaker's emails and perhaps private information on how to contact them. So we want people to log in before they get that sort of information. But it will all be there, and I'm planning on creating a video and an audio podcast feed from it as well.
Okay, yeah, I wasn't sure if there was another website that we needed to go, because unfortunately I couldn't make the first half of this meeting, but it seemed very informative. So I wanted to try to get the replay as soon as, and I didn't know where we would go because of the limited amount that's on the.
Tell you what, I will. I need to post last week's and this week's, and so I have time set aside on Saturday to do that. So check by hopefully midday Saturday, and they should be there.
Okay. And to register on the website,
there's no registration yet on the website. In the future, there will be.
Okay, gotcha. Just making sure. Okay, cool.
All right.
Yeah.
Thank you.
Thank you very much. Thank you.